So as we look at this news and the potential impact on the markets, what are you watching? What are you looking at as a sign that investors are perhaps distressed about this news that, again, the president says he is firing Lisa Cook, but Lisa Cook says she will not resign?
Yeah, it's a great question. It is certainly the news du jour. I think, unfortunately or fortunately, the market has seen a lot of this noise coming out of the administration already this year on a number of fronts as it relates to different policymakers. The story's a little bit different, but the tone is somewhat similar. So I think the market is starting to get conditioned to some of this noise. And I think, unfortunately, the market is taking this in stride. Feels a little counterintuitive, maybe. But the net effect of what's going on here, I think, doesn't really change the longer term path for rates. And so as long as the market views this as a continuation of a more dovish or accommodative Fed and that rate cuts are still to come, hopefully in the short term here, I think the market is basically going to take it in stride. So short-term noise, we're seeing a little bit of that this morning, although not too much. But I think the market does start to settle down once we get a little bit more clarity.
All right. As we look at what potentially could happen here, our CNBC markets teams kind of laid out some of the scenarios here where the president could actually have a 4-3 majority on the Board of Governors next year if, Moran, again, is filling Kugler's vacancy, and then also he's able to remove Cook and put somebody else in there. Is that something that you see the market being in favor of? The idea that there wouldn't be that same sense of Fed independence, but there would be a more, potentially at least, aggressive rate cut strategy?
Yeah, it's a tale of two different points of view. So the equity market will love this, right? The equity market craves the sugar high for more stimulus and more policy accommodation, of course, in the form of rate cuts. So the equity market, I think, will take this in stride and view this as a positive development, even though I think we're already headed down a path towards policy accommodation rate cuts. So I'm not sure that it changes the story all that much. Bond market, I've been saying all year, is the adult in the room saying, Houston, we have a problem here, right? So I think the bond market is going to get potentially a little bit more stressed. I think the risk premium, you're seeing it in the move in yields here. I think the risk premium is going to continue to creep higher. I think it's certainly a reflection of the steeper yield curve. So two different points of view, depending on the focus from investors, I think, based on the path forward here for the Fed.
So I know you said the equity market's going to like this, but the real question is about the bond market and potentially those bond vigilantes. So S&P Global, they actually warned earlier this month after they affirmed the U.S. credit rating at AA+ that these ratings could come under pressure if political developments weigh on the strength of American institutions. Do you see this as a potential moment where the U.S. credit rating could be downgraded based just on the turmoil? We don't know what's going to happen, obviously. Lisa Cook's pushback against the president's firing, but just the turmoil itself. Do you see this potentially leading to a downgrade?
Yeah, I wish I had a good answer for you. I wish I had my crystal ball forecast shined up and ready to give you an answer, because it is sort of the billion-dollar question, as it were. Do I think this is the single variable that's going to drive a downgrade? No. But to the extent that we see a more pervasive approach here, certainly it's one in a series of factors. So it's not the thing that's keeping me up at night at the moment. I think the thing that's keeping me up is much more about deficits and debt levels and the steepening of the yield curve and how much room it actually gives policymakers in this environment to do what needs to be done in terms of trying to get to a solution. We don't have a solution here in terms of how to solve for that. And so I think that's going to continue to weigh on yields and certainly, as I said before, push up the risk premium for treasuries in particular.
So, Amanda, with that, very quickly, we got to go. Where would you put money to work today? Where's a safe trade?
So I think the safe trade is certainly in technology. You cannot bet against technology given the AI race that we're in here. I think there are pockets of opportunity in industrials and certainly in financials from a sector perspective. But we're really focused on factors in this environment, given how fast things are moving. And so while we've been talking a lot about quality all year, it's starting to get to be a bit more of a fully valued trade. So I'm not sure quality is the safe haven it once was. So we're focused on size and earnings stability in the back half of the year, given all the volatility that we're starting to see.